Good afternoon. My name is Kanwar Singh, and I'm with Hamersley Partners, a Boston-based asset raising firm. We'll get started momentarily. Thank you. Good afternoon. My name is Kanwar Singh, and I'm with Hamersley Partners, Boston-based asset raising firm. Really excited to see all of you here. I'm not sure why you decided to attend. Maybe it was the baby or it was the dog that we had sent out in the email invitation, but we're really delighted to have you here. This webinar is being recorded, so after the webinar ends, you will be receiving a presentation as well as the recording of this webinar. If you would like to tweet or share this webinar on Facebook, you can use the hashtag Thematic. We had included that in the instructions, so we encourage you to do that as well. Now, before we begin, we want to make sure that listeners will be muted. And if you want to ask a question, feel free to type it out. So this webinar will last approximately 30 minutes. After this webinar ends, we will have a Q&A session with Peter Pavlina, Rob Uick, and then Bill Page. And we will be bringing in the questions from the audience. So don't hesitate to ask questions in the meantime. On this webinar and on this deck, you'll see sources that are cited at the bottom of each slide. So feel free to research those sources and learn more. Myself and my team have spent a lot of time researching and preparing for this webinar. And we want to make sure that not only do you find this webinar useful, but you can actually leverage the resources that we are sharing throughout this webinar. And you can even share those with your friends, colleagues, family members, etc. Now, before we begin, I also want to highlight that this webinar will have Peter Pavlina, Michael Wren, both of whom are from Hamersley Partners, including myself, and then we'll also have Bill Page and then Rob Uick representing SX Investment Management. Let's take a look at the agenda. So throughout this presentation, we'll highlight the solutions that exist to incredible problems that we're all facing: climate change, rising seawater. But we're not going to focus on the problem itself, but the opportunity that presents for the investors. We'll also highlight the impact investors can have. So that begins with more disclosures that are coming out from companies. We'll talk about the progress UNPRI and SASB have made in this space, and we'll also share our belief and opinion that most managers will eventually become ESG managers. From there, we'll highlight the main distinction between thematic and ESG managers. And then finally, share one of the brands we represent in Hamersley Partners called GEOS, the Global Environmental Opportunities Strategy, and how you can make an impact by investing in a manager like GEOS. So let's take a look at the solutions that exist. Again, this presentation is not about the rising sea levels or climate change. There's a lot of research that has been done on that. Instead, we want to focus on the opportunity set that presents to investors. Investors want to leave a legacy. They want to make sure that they can have an impact through direct investments that they're making. And that's what this presentation is all about. It begins with companies. Increasingly, companies have realized that they need to make more disclosures. They want to assuage the concerns of their various stakeholders, including investors, employees, activists. And so as a result, what we've seen is more and more companies are filing what are called as corporate social responsibility reports. In these reports, for example, companies highlight how they're working with their suppliers, how efficiently they're utilizing water, and how they are reducing their carbon footprint, among other factors. And as a result of this increasing disclosures, investors are incorporating these disclosures in their investment methodology. And this is a good trend, and we commend this trend. Now let's take a look at the next slide, which shows the prevalence of CSR disclosures globally. So as you can imagine, this is not just a US or European phenomena. This is a global, worldwide phenomena. More and more companies, global companies, are filing these corporate social responsibility reports. Now, let's talk about why that's the case. Well, companies realize that, again, they have some pressure from stakeholders. they're not being forced to make these disclosures because of regulators. Investors, institutional investors, and my colleague Peter Pavlina, who's going to talk shortly, will actually touch on this in more detail. And the companies also want to have access to global capital markets. This is the new way of doing business. If they don't have these disclosures out there, investors will have a tough time investing in these companies. And that's our main point here. And what we believe is there's no going back, so you'll see perhaps even higher percentage of companies filing these disclosures worldwide, not just in the US. Now, to talk more about disclosures, ESG, and thematic investing, I'm going to pass it over to my colleague, Peter Pavlina. Peter?
Kelmar, thank you. And with that, I would say that was a very nice introduction.
Sure
Thank
thing.
you very much. And, you know, when Kelmar was talking, he was saying, you know, why are people attending? And I think maybe they were curious who Kanwar Singh is. So now you know. Well, anyway, thank you, everybody. Good afternoon. It's great to see all of you here. Maybe just a little bit of background why we're having this webinar. After doing a lot of meetings, being on the road for, you know, the last 9 months or so, what we found is there's really massive confusion out there in the marketplace about what is ESG, what is impact. And so we decided, gee, you know, we should really try to clarify what that is. And so here we are talking about disclosure. And Kelmar touched on that just a moment ago, but what you see is the evolution of disclosure. And as a CPA and also, frankly, an accounting teacher, of all things, I appreciate good disclosure. The more the better, in fact. The points I want to make here on this particular slide is you notice that the evolution of disclosure continues, whereas earlier in the 1800s, early 1930s, as you can see, disclosure was very much about financial disclosure. Now it's evolved to the point where it includes sustainability. So this is a trend that is firmly in place, and again, alluding to what Kalmar said, somewhat of a natural evolution for companies in the public domain. The markets like transparency, and so that's what's happening. This is not going to go away. Here you see a little bit of information on the UNPRI. I think most everyone is familiar with UNPRI and the fact that there's all these signatories. Here you see the list of signatories. Most of them are in Europe. The majority are, and there's a lot of investment managers. And then you also see the 6 principles there. The important thing to point out, these asset owners are very influential, large asset owners, big state public pension plans, sovereign wealth funds, and so forth. One thing I would like to mention, from my experience, social impact investing goes back decades. If you've been in the business as long as I have, some of you might remember South Africa free portfolios. When I was running international equity portfolios, we actually had portfolios that excluded South Africa stocks that had exposure to South Africa. And that was really driven by very large institutional investors who were supporting the anti-apartheid movement. The UN was behind that. We expect the number of signatories to grow, and as we like to say at Hamersley Partners, the trend is your friend. This trend is not going away. Here we're looking at the growth of assets under management that fall under the UNPRI dimension, and you'll see that the $70 trillion is where it stands now, about 1,600 or so signatories. Again, very large institutional investors are behind that. And so what this means for managers and also for asset owners is there's a big trend and a lot of pressure to do the right thing. And so this is a trend that's not going to go away as well. Last month, I attended a SASB workshop. It was an interesting workshop, and the long and short of it is we were looking at a number of SASB metrics. And here I've listed a number of those metrics. And what we're finding is analysts, and like we were doing in the workshop, are using this data and these inputs as part of their financial analysis. So they're taking air pollutants, water withdrawn, energy consumed from the grid, etc., and incorporating that into DCF models and valuation metrics. SASB's done a remarkable job. I encourage you to look into SASB a little bit. In the back, in the appendix, we have a copy of the SASB materiality map. I would encourage you to have a look at that. The main point is transparency is here to stay. So what does this mean for investment managers? Well, if you're an investment manager and you're filling out an RFP and there's questions related to UNPRI, sustainability reports, ESG, etc., you have a major incentive to get those questions correct. And so the pressure is on managers to integrate ESG into their process. In fact, it's so important now how managers answer these types of ESG questions, because that affects their asset raising. Similarly, consultants are looking deeply at ESG. Here you see Mercer's ESG ratings, and these are ratings of managers on ESG metrics. And so the ratings go from 1 to 4, from high integration down to low integration, and this is happening across the spectrum. There are a lot of other consultants that are doing these things. The bottom line is managers, more managers are integrating ESG into their process because they want to have good ratings. Moving on here to the next slide, as most of you know, this whole sustainability ESG investing space has really become mainstream. Investors want it. Managers are responding with products. And in this particular chart, you see it's a U.S. SIF. This is from the U.S. SIF Foundation. Again, you can get more information on U.S. SIF in the back of the book. But this information and this trend of more assets under the ESG umbrella is coming from two sources. A, it's new products, newly branded ESG products, but it's also very much about old products that have been around for a while that are being rebranded ESG. You take an international equity manager and you do some things to your process, and now it's an international ESG manager. Here we have two tables. The one on the left represents ESG managers, and the top funds, and we did a little research into this, we took the top ESG managers, when I say top, I mean the largest AUM managers, and then over on the right-hand side, we have non-ESG managers. And key takeaways on this particular slide is that ESG managers have very much a large cap bias. And why is that? Well, it's because of the large cap names are the first names in universes that have ESG coverage. If you're going to do an ESG analysis, you'll start with the larger companies rather than smaller companies. And further, you see the two groups, the one on the left and the right, there's a lot of overlap. You see Apple, Microsoft, Amazon, Alphabet. You'll see a lot of overlap. An important point is that the ESG space, ESG manager space, has become very crowded, and therefore it's truly hard to figure out who's credible and who isn't. And I would argue that as more companies address the sustainability issue, CSR reports or however you want to characterize it, the harder it will become for managers to differentiate themselves on ESG criteria alone. We can see this here as well. On this table, we have MSCI World and MSCI World ESG indices, and you see really no discernible difference in performance. We have calendar years and calendar year performance and annualized performance. We expect that the overlap of names in these two indices will grow as more companies integrate sustainability practices, going back to what Kalmar said about CSR reports. And this brings us to the main point, or one of the main points of our webinar here, and that is we expect most managers over time will become so-called ESG managers. And why is that happening? Asset owners want ESG integration. Consultants want to see ESG integration. Investors and clients want to see ESG integration. In fact, we believe that ESG disclosure will be as common as GIPS disclosure, compliance disclosure, trading disclosure. It's going to be another check the box. Yes, we do these practices. The point is that managers are realizing that AUM growth, assets under management, is affected by how well they articulate their ESG integration. Moving on and sort of shifting gears here, we wanted to make the distinction between thematic and ESG managers. So you have two columns there, thematic, around 50 managers that we are looking at, or sort of following, I guess you could say, and then ESG managers, and that 5,000 comes from that previous slide. And the key takeaway here is that these two categories are very, very different. Just look at some of the items there. I won't go through everything, but look at portfolio holdings, for example. Thematic managers are the managers creating the impact solutions. I'm going to put Bill Page on next, and he will talk about some of those solutions that Bill Page runs GEOS, and the companies that they own are creating the impact solutions. Whereas the ESG holdings, the stocks that the ESG managers hold, are using the impact solutions. The number of holdings, the third line item there, thematic is far more concentrated than ESG managers, which are far more diversified. If you look at sector exposure, third from the bottom, you'll see that in terms of the thematic managers, one or few sectors are represented there. In the ESG category, all or most sectors are represented. And in terms of asset allocation, thematic is more of a satellite alpha solution to the ESG, which is more of a core beta solution. So that's a little bit about the difference between thematic and ESG, and we'll move to the next point here, and that is targeted, the targeted themes that we've looked at. These are different types of themes that managers are running, and the important point is that there are a lot of ways for investors to express their impact preferences, and so we've listed 6 here. And again, just to really emphasize, ESG is different from thematic, because thematic is very targeted, very focused on specific problems or issues or topics, as opposed to ESG, which is a broad-based portfolio that looks at how ESG is integrated, and they use criteria. Just like the dog and the baby said in the webinar ad, true impact happens with thematic managers. Where do the thematic managers fit in an asset allocation profile? Well, you can see we've listed 8 here, and again, this comes from talking to investors and getting feedback and from the clients that are currently in GEOS. There are many different ways that investors look at GEOS and where they actually put it. Well, and we can say that broadly and generally about thematic managers. They're used in many different ways, and I won't run through all those, but you can see for yourself. This particular slide looks at some of the common benchmarks some of you might be familiar with, but one of the point I want to make, one of the challenges a thematic manager faces is, what is the right benchmark? And after a lot of conversations with people, some of them investors in GEOS and some outside investors, these are some of the benchmarks that have come up: clean energy, commodity, environmental, infrastructure, industrials. So there are a lot of different ways to compare a thematic manager. We expect with time you will see more theme-focused benchmarks. Now I would like to turn our attention to our client. The firm is Essex Investment Management. In fact, I'm very pleased to be sitting in their offices at this moment. And their GEOS strategy. GEOS is Global Environmental Opportunities Strategy. It's a portfolio, a concentrated portfolio of impact solutions. And we looked at, before we agreed to work with GEOS, we looked around at other managers. What we really liked about GEOS was the fact that they're very focused on themes, and they have great domain expertise. These guys are truly experts in, as we say on the bottom there of the slide, listed equity thematic solutions. I am very pleased to introduce you to Bill Page and Rob Hewitt. They've been running the GEOS strategy since 2009, and they are truly ESG experts and recognized as so, recognized as impact solutions experts. And if some of you already know Bill, I realize that, but we're very proud to represent them and excited to have Bill talk a little bit about his portfolio. So with that, I'm going to stop there and introduce you to the famous, talented Bill Page. So here, if we can clap, we would clap, but we can't hear any clapping here. So Bill, please have a seat.
Thanks, Peter. Appreciate it. And thank you all for joining today. We really appreciate you spending some time with us this week. So Rob Hewitt and I are going to talk for a bit here about the GEOS investment process, philosophy, some of the key areas of focus that we see as attractive in the markets right now as a social impact solution. And what GEOS is we invest in the public equity shares of companies that are solving global complex problems. So we invest in technologies that provide economic growth with less environmental degradation while improving the quality of life. So a really key risk and opportunity for us is the economic forcings around urbanization. So we've got 45% of the world's population lives in cities today, and that will be, we believe, growing to over 75% in the next 20 years. So a key investment trend for us, and we think this is a huge economic shift, a tectonic shift that's happening slowly over the next 20 years. And this provides a risk, but more importantly, an opportunity. So what we really want to do with GEOS is invest and harness the opportunities through technological solutions. And so the economic transitions are happening with more prevalence in the emerging markets of the world. That, coupled with global climate change and technological progress, are all catalysts that we're really harnessing with GEOS. And so this is a really dynamic, ever-shifting area of the capital market. So you see on page 22, the inefficient portion of the capital markets is really key. We believe it's a differentiated portion, undercovered, currently unloved, very little sell-side coverage. We believe per level of growth, very, very sound solutions there. So we've been harnessing the solutions with GEOS for close to 8 years now, and we've been taking the message out to the market and becoming increasingly recognized regarding the differentiation by some of the organizations that are listed here. But I also want to say that GEOS, the solutions that we're investing around, can abate a lot of the risks that are talked about quite frequently amongst ESG conferences and circles. So a little bit more about our areas of focus. So the areas of focus for GEOS, this illustrates our current strategy. We have 5 areas of focus currently. I think Smart City best exemplifies and demonstrates what clean technology is. It's not a lab experiment, it's real, it's happening, and it enables consumers in the economy to operate with greater efficiency and with better quality of life. So examples of smart city technologies, and we're invested in many different segments of the smart city, but it's LED street lighting, automated and linked to traffic controls, which save energy and lives. Smart cities are all becoming more interconnected through technology. So you have electricity grids that are running more effectively, more efficiently. You have time of use, energy, electricity supply services that are running at time of use. We have exposure to sensor technology, smart meters, power storage technologies, efficient building materials, electric cars and power storage, and enhanced utility software and services. So all this can enable cities to operate with less environmental degradation in improving and enhancing the earth while saving natural resources. Water there, I'll just mention one other one, is key. It's completely interrelated and directly applicable to a causal and multitude of global trends directly related to clean technology. So we invest in water management, providing water efficiency services and technologies, as well as water infrastructure, are key areas of focus for us. And so if you think about in the developed markets, we need to put about $1 trillion in the U.S. into our water infrastructure every year. That has not happened at all. So we see that often demonstrated the need for more infrastructure with water quality issues and water main breaks. And then I'll segue over to the emerging markets of the world where water quality and access are key themes we're invested in also. So 2 of the areas of 5 areas of focus. On the residential side, so residential efficiencies enable consumers of electricity, water, and natural gas increased transparency of pricing and better service quality. So when you have more transparency of pricing, you can change behavior on the part of consumers to actually save money in the home and actually improve the quality of life, because you're operating your appliances within the home more effectively and efficiently. So you're not going and operating power-hungry appliances in peak demand times where power prices get higher. And we're seeing a great decoupling of power pricing in a lot of unregulated regions of the world. So this is, when you talk about the home, this is so-called behind-the-meter technology, connecting these appliances through what's called the Internet of Things. You've probably heard the term IoT, and that's really due to the success of a firm that's a key holding of ours, Silver Spring Networks, there in the lower left. So Silver Spring provides a software and services backbone linking home behind the meter to utilities to measure and enhance service quality and performance. So you have a better link between consumer and the utility itself. Itron there on the right-hand side is a related company, a little bit more on the hardware side, providing smart services and software for utilities and customers to measure water, electricity, and gas usage in the home. So that's on the residential side. Now moving on to the industrial side, just as key for us, just as a large component of our current portfolio. Especially prevalent today, clean technology enables companies that are adopting these technologies to enhance productivity in what has been a low-growth environment. So if you think about, if you can't get top-line growth, if you're a large commercial or consumer products company, you really need to hone your manufacturing process to get those margins improving. And that's how all of these companies bring to bear in various different end markets. So commercial productivity enhancement is very important. We've got 2 examples on the left there, and these are companies that help manufacturing companies and industrial companies track their goods and services. So it could be inputs, it could be materials that are used in the manufacturing process, in tracking them, asset tracking when it leaves the facility. And then you've got FANUC, which helps with industrial automation to improve workplace safety, enhance the throughput of the company, and again, improve the efficiency and the productivity of the entity. That is really key. So clean tech to us is here and now that enables these companies to operate more productively. Lastly, on the upper right, we've had a company that's been with us in the portfolio since inception in 2009, a company called Kingspan. It's an Irish building materials company based in Dublin. When you are running a company, whether it's a cold store warehouse or a server farm, you really need to hone in and do everything you can to save energy, because upwards of 75% of the input costs for a server farm are energy related. What Kingspan does is the most advanced technology globally for saving energy through building materials. So these are insulated panels and floors. They're very, very high R factor, so very efficient, that enable companies to save on heating and cooling costs. Some examples of key areas. Now what I'm going to do is introduce my co-manager, Rob Uock on GEOS, to talk more in depth about the investment process.
Great. Thank you, Bill. I appreciate the opportunity to be here today. And I want to shed a little bit more light, as Bill mentioned, on our investment process, and then I'll also discuss a little bit about Essex as a firm, and then I'll turn the call back over to Mike Wren for Hamersley to wrap things up a little bit. So, as we've mentioned a couple of times on this webcast and this webinar, we think that the investment opportunities are significant for meaningful capital returns over time. The subset of companies that we're looking at all have growth tailwinds to mega trends that are continuing to propel opportunities into the future. and it is an inefficient portion of the capital markets where we think that these companies are underfollowed by the sell side. The technologies and the macro landscape and specific end markets can be complex and need skill. And so a skilled manager can find these opportunities and create alpha. The output of the portfolio, as we can see on the slide here, there's three aspects to the process that I'd like to discuss. And the output being a portfolio of about 35 stocks. It's concentrated, it's global, and we're investing in stocks with great growth opportunities, good returns on capital, and also solving for many of the environmental challenges that the world is facing. One unique aspect of the GEOS process in our team is we take a balance between the financials and the environmental impact. As we say, we're at the nexus of environment and finance. The first step of the process is our thematic universe. We have a proprietary universe, about 600 stocks. To get into the universe, you have to have a minimum market cap of $100 million, and about 25% of revenues or more are coming from one of our environmental themes. We rank this universe in real time on growth rates, we rank it on valuation factors, we rank it on financial health metrics. This ranking system allows us to narrow down the 600 stock universe to a list of about 100 companies at any point in time that we're following more closely and digging into as a starting point for our fundamental research. It's also informed by the rest of our research discussions with various industry participants and consultants and all the reading and the rest of the research that we do. The second aspect of our process, the attractive fundamentals, where we're doing deep fundamental research. We are meeting with the companies, all the companies in our portfolio, many more companies in our universe that we don't necessarily invest in. We're meeting with, we're talking to their peers, talking to their competitors, suppliers, customers, reading regulatory filings, understanding the technology, consultants, talking to venture capitalists and sell side. This allows us to really understand the fundamental drivers of not only the companies, but the end markets, allowing us to produce fairly accurate models in terms of whether we think the revenue growth rates are going to be, where the operating margins can go, what we think the targets and company valuations are. Importantly, we're also considering downsides. What are the opportunities that exist, but also what are the risks? What's the probability of each? So that we can have a real meaningful upside-downside analysis and determine which appropriate price targets are and what our ultimate portfolio is going to look at. The third aspect shown on the slide here, the domain expertise. Bill and I have been analyzing companies and investing in an institutional setting for 20 years. We're very strong on the financial side. The past 10 years, we've been focused almost exclusively on investing in the environmental opportunities. And so this expertise has allowed us to build up a lot of knowledge on companies, technologies, end markets, landscapes. There's a very high failure rate of a lot of promising technologies and a lot of companies. We want to avoid lab experiments. We want to invest in those companies that are past the tipping point so that their technologies, their services make sense to the customers. They're giving returns on capital to their customers. So it's not just a technology that might be 10 years from fruition that's going to continue to need further capital. That's an important part of the aspect of what we do. To summarize our process, we end up with a portfolio of about 35 growth stocks. Again, we want to see higher improving returns on capital. The financial returns are important to us. And we're also offering an opportunity to invest in environmental solutions that are helping to solve many of the world's environmental challenges. We take a long investment horizon. We think like private company owners. We think like private equity owners. We're looking out 3 to 5 years. We're building the detailed models. We have a low turnover rate in the portfolio. On an annualized basis, it's about 40%, but half of that is used internally within the portfolio where we take advantage of volatility in the market. So when companies are trading rich, we either sell or trim our positions. Where companies are trading cheap, we'll either buy or add to our positions. That internal turnover is about half of what we do. So in terms of new names, about 20% of the portfolio is turned over each year, which suggests a holding period of about 5 years. Just turning to the next slide, a little snapshot of GEOS, the portfolio, what it looked like on as of the end of the third quarter. And again, I want to emphasize that on the left-hand side, we can see how it was dispersed across the 5 areas of focus. We have 14 stocks in our smart city category. This changes over time. It's a completely bottom-up process. The portfolio was informed by our fundamental stock research, what our valuation tells us, what our risk rewards tell us. We are not making top-down allocations, for example, where we say that we might want to have 20% of the portfolio in water opportunities. So these weights obviously change over time as it's informed by our differences in forecasts and upside-downside risk-reward opportunities. Geographically speaking, we do have a U.S. bias. About 60% of the portfolio is in the United States. The other 40% is overseas. We are global, largely exposed to developed markets, although recognizing that we are investing in growth companies and they do have exposure to the emerging markets. This is obviously an opportunity. It's been a little bit difficult the past couple of years for many emerging markets given the slowdown in the global growth rates, but that is where all of the marginal growth of energy usage comes in the world, is emerging markets. And so they're the ones who are increasingly taking in more of the technologies and services from the companies in which we invest. Just briefly about Essex itself, Bill Page and I joined Essex with GEOS about 8 years ago. Essex is bigger than just GEOS. It's been around for 40 years, founded in 1976. The firm currently has about $630 million under management. GEOS itself is about $50 million under advisement. And again, the firm has always been invested in growth opportunities. The DNA of the firm is early identification of growth, thematic opportunities. So it was a perfect fit for GEOS when Bill and I joined. And importantly, we are a 100% employee-owned firm and are incented to focus on those things that we do well. I'd now like to turn the call over to Mike Wren from Hamersley, who will give a little bit of a wrap-up, and then we'll be following that with the opportunity for questions and answers. So if you do have questions, feel free to write those into the webinar dashboard, and we will address those in a few moments. Thank you.
Okay. Thank you, Rob. Nice work. Yeah, and again, that webinar dashboard should be something that's on the right-hand side of your screen. If you do have any questions, feel free to ask them. Michael Wren here, Hamersley Partners. Thank you, everybody, for joining us. I will wrap this up shortly here. What I want to just take you through is a couple of different ways that people look at GEOS and different clients use them within their portfolio. The chart that you're looking at in front of you here is the growth chart, AUM chart that you have seen. I'm sure, no doubt, many times over the course of your careers. What's unique and what I want to point out about this one is that, you know, Bill and Rob, in many ways, are innovators within the impact investing space. Traditionally, this impact investing has been done solely through private markets. And in 2010, if you told somebody you were trying to make an impact through the public equity markets, they would have laughed at you. But over the course of time, as people are looking for different avenues for alpha and different avenues to try to do good with their money, you can see it's been steadily being adopted. The assets have been doubling every couple of years now, and you know, as people look for more liquid solutions, we expect that to continue. And the pipeline has really never been stronger. The client base is primarily made up of multifamily offices, endowments, foundations, mission-oriented investors. The next slide here is just a little bit of investor feedback, a few quotes that we wanted to pick out and we thought really illustrated the different uses that you can have for GEOS as a part of your portfolio. The first one there says we use GEOS as a complement to our ESG portfolio. We put that one up at the top because it's really important to highlight the fact that most, if not all, of GEOS's clients use them as an alpha generator within a traditional, or excuse me, to complement a traditional ESG portfolio. We talked about all those different ESG portfolios and what they're made up of and how they're very highly diversified. Coming at it from a different angle, Bill and Rob are able to really add some value in a much more concentrated portfolio. The second bullet there, our clients want to leave a legacy and make a sustainable impact through GEOS. I think this really relates more to the multifamily office clients in the sense that as the younger generation comes along and they're having more control over of where the family money is invested, they're asking more questions about how to do good with it. And I think that, you know, if they're looking for a more liquid solution, that GEOS can certainly be something that could be explored. The portfolio managers at GEOS are truly domain experts. I think we've also talked about this quite a bit, and if I'm repeating, I apologize. But basically, you know, Rob and Bill have been at this now for over 15 years. They're again, like I said, they've been I would consider innovators within the impact investing space within the public equity markets. And if you get the chance to sit down with them and talk to them about not only their portfolio but the space that they're playing in, I think you'd be really impressed as to the depth of knowledge and insight that they'd be able to provide. The final quote there, GEOS is a substitute for commodity allocation and reduces the overall portfolio volatility. I think that relates more to some things that Peter hit upon earlier regarding benchmarking and where does GEOS really fit within an overall portfolio? It's hard to pin it down. There's no great benchmark out there as it is right now, but clients are using them as a commodity substitute, as an inflation hedge, infrastructure play, and certainly again as part of a more overall complement to a larger ESG portfolio. And as we wrap up here, I think that it's important to talk a little bit about Hamersley Partners. What we do is we try to raise institutional capital from investors across the globe, and one of the ways that we feel that we can be successful doing that, and one of probably the most important way we can be successful doing that, is choosing the right partners. We feel like Essex and the guys at GEOS are about as in touch and in tune with the space that they play in as you can possibly be. They're best of breed as far as thematic managers out there. We're really excited and proud to be representing them. If you have any questions for us here, please don't hesitate to ask again, or you can certainly follow up to any of that information that we have there. And what I'd like to do now, I think, is just turn it over to Bill, Rob, and Peter, and let them answer some questions that have come through. And again, just feel free to ask them as we go. Thank you. You guys go first, gentlemen.
Musical chairs here.
Hello.
So bear with us.
Okay, so it's nice to be back here and with Bill and Rob, and thank you again, everybody, for attending our webinar. I'm just going to scoot over so I'm in the camera. So we have a few questions for you guys. So far, it looks like there's like 5 questions that have come in. So let me just hit the first one. And the first one, I think, is maybe directed to you, Bill. And the question is, given your areas of focus, you mentioned 5 areas, which is your favorite area of focus at this time?
I think so. We run a concentrated portfolio, so de facto, everything in the portfolio is our favorite. But I would say that let me highlight some areas that are gaining a fair amount of traction. So when Rob mentioned we don't do lab experiments, commercial viability is really important. So I want to hone in on agricultural productivity, which is up there as one of the areas of focus. So in agricultural productivity, there's an ag cycle, and we need to be mindful when we invest in things like irrigation, not in the portfolio right now, about that ag cycle. But more importantly, there's a secular trend afoot right now to enhance farm productivity through the growth of GPS technology. So we have 2 stocks in the portfolio doing GPS technology, and this gets down to actually from the farmer's office in the home to the cab of the vehicle at the farm. So this is a key area for us. Raven and Trimble are 2 of our investments there. I just want to close on efficient transport. So another key area. We actually just saw some very exciting news this week about the enhancement, the first step to autonomous driving. Autonomous driving doesn't mean we're going to have full-on Tesla S's running around, fully automated, but it does mean that we're going to have a step to that through enhanced sensor technology, car-to-car communication. And so that's a key theme for us in the improvement in the avenues around that technology that enable more energy efficiency for the car.
Great, thank you. The second question that was asked addressed the incoming administration, and what does that mean for your portfolios? So maybe Rob, you can.
Sure, I'll tackle that question. It's a question we've had quite often over the past few weeks since the presidential election. I want to stay out of politics. It's a very polarizing subject, but I'll talk about how it has impacted our thought process in our portfolio. I'd start off by saying that the portfolio is hopefully you got a flavor of the process and what types of stocks we're looking for. We are not investing in companies that are solely dependent upon government policy and government subsidy regimes. Obviously, there are policies and incentive schemes in place that could benefit some of the potential investments that we do have in the portfolio. But again, we are mindful of this. We spend a lot of our time assessing the landscape, both politically and macro, to see how that could impact the companies. And so we assess these within our regular risk management process. That's the first thing I would say. Second, obviously, President-elect Trump has made a number of statements that could be concerning from an environmental standpoint. We think that, as any president does, the end result will be moderated somewhat from some initial statements. The second way we think about it is just say that this is a global movement. And so the environmental challenges we have are not U.S.-centric. In fact, they're quite more significant in many other countries of the emerging world, particularly China, India have significant environmental challenges. They need to address these issues and solve these problems today. Their policies are actually quite the opposite, where they are encouraging as much as they can to move away from fossil fuel burning for electricity, et cetera. So these are global movements. The momentum is in place. Even here in the United States, recent polls would suggest that both Democrats and Republicans are in favor of policies around renewable energy, et cetera. So we think that there will be some moderation. Obviously, the Clean Power Plan could be at risk, but our discussions with utilities would suggest that regardless of what happens with the EPA and the Clean Power Plan, that utilities are not going back to burning coal for economic reasons, for environmental reasons. They're going to move, at least on a transition basis, more towards natural gas. And finally, the area of risk in a portfolio that is probably most significant would be solar. That currently is less than 4% of our portfolio. It's not a major focus of ours right now. We think the incentive schemes are probably okay. They were originally passed by our administration under a Republican president. They were extended last year by a Republican Congress. And so we think that those are probably safe, at least here in the near term. And so we're mindful of the potential changes, but we're going to continue to assess that.
Good. Okay, let me go to the third question we have. And well, I guess, okay, I was just asked to ask this question here. Let me read the question, if I may. I'm not sure I totally understand the question, but I'll read it. It says, if the companies in which you invest have attractive fundamentals, they should be attractive to all competitive public markets managers, and there are a lot of those. How does this strategy create an additional impact in public equities above that which would happen anyway? So
I think let me take a shot at it, Rob, and then Richard. Social impact reporting is something that it's a key component of what we do with GEOS. And so when we talked about the inefficiencies of this portion of the capital market, so as Rob discussed, we have an all-cap universe. And as Peter mentioned, as you swim up in market cap, there's more disclosure, there's more information. In the segment of the portfolio that we're investing with GEOS, it's been consistently small and mid-cap, because that's where we see the best expression of our philosophy. And it's also, more importantly, where we see the best investment opportunity. So with that in mind, a lot of the companies that we hold are looking for long-term holders. So they want to get investors into the portfolio. They don't want to see their shares leased by hedge funds because of the factors of the revenue streams of these companies, which are more volatile. So we have a lot of access to these companies. It's a very inefficient portion of the capital market. By doing so, we actually frequently engage with these companies on how to get their story out there in the marketplace. So I hope that helps.
Yeah, I would just add to that, to finish out the discussion. I would say that there's nothing more that we would want than to see everybody own the companies that we own. We think that these are fantastic opportunities. We think our focus on the area allows us to uncover these opportunities before many of the mainstream managers. As we mentioned, this is inefficient. A lot of sell-siders aren't covering these companies, recommending them to other buy-side firms. A lot of the technologies take specific time and dedication to understand and have the confidence to invest in these companies. Over time, we think these values will be uncovered and they will be held on a more widespread basis. We're tasked, and what we try to do is identify these companies in an earlier opportunity for significant capital gains.
Great, thank you. That's a good answer. Appreciate it. So why don't we turn the focus to adoption rates? And I'm wondering, this question here asked about adoption, and I'm wondering what you would say about this, and maybe in the context of your areas of focus. Where do you see the fastest adoption rates for some of these technologies?
Yeah, so with GEOS, we invest in technologies that are technology solutions. They're all growing exponentially. So when I say they, the technologies that we're most enthusiastic about. So if you think about LED lighting, if you think about solar, the sensor technology, those are the key tipping point technologies. So we're past the tipping point. These technologies are going mainstream, so they're commercially viable. The interesting thing is, though, at some point, as technologies and industries progress and mature, you do get to a point where you can have issues with growth trajectory. So when Rob talked about solar, we've had it's doubled 200 times the solar market. So the growth rate is amazing from 1980, and it's even increased 90 times in the last 10 years. So we've had enormous growth in the solar market, but at this point, a lot of parts of the value chain are unprofitable. So most commercially viable right now in the tipping points we see in LED lighting, in solar technology, and then we're modeling growth in power storage. So the battery market has been coming down to the point where we're starting to enter the point where we could see a tipping point in the electric vehicle market the next 5 years.
Yeah, but as Bill kind of mentioned, it's important to understand that growth itself is not the investment thesis. There's been plenty of growth in solar in the past year. It's tough finding investment opportunities and areas to invest profitably. We want to see returns on capital, not just growth.
Right. Okay, good. Thank you. Rob, you answered the question on the incoming administration. Another question asks about the economic cycle and what that means for your holdings.
Sure, that's a great question. So we are growth managers. It's important to understand, and as I hinted at during the discussion of the investment process, many of the companies in which we invest are exposed to global growth. And so there's been a challenge in the past 2 years in particular where we have a slowdown in global growth, particularly in the emerging markets, which is traditionally the engine of growth. Over the past 25 years, the engine of growth in the world has been emerging markets. That's where all the marginal opportunities are. And so when we see a slowdown in those areas, that impacts a number of the portfolio companies. If you were to look at on a pure economic sector basis, our portfolio, about 70% of our portfolio falls within either technology or industrial sectors. And so the slowdown that we've seen from a growth perspective over the past couple of years has impacted many of the companies in which we invest in the industrial space in particular. We do think that kind of since the beginning of this year, it's felt like that has shifted a little bit. We're starting, some of the economic indicators around the world are starting to suggest a pickup. Certainly commodity prices, if you see them as a leading indicator, they would suggest that we're seeing at least a recovery of growth in certain areas of the market, which would be good for kind of the growth areas that we invest in.
Good, thank you. Maybe another question, if we could. I think we still have a little bit more time left. I was talking a little bit about benchmarks during my portion of the presentation, and I'm wondering, Bill, maybe you can comment on that. I know it comes up a lot. People are curious about it, and this question is asking, so what is your goal? What is your performance goal, and how should you be judged? What benchmark is appropriate, or benchmarks maybe?
Yeah, I hope one thing the participants have taken home is the fact that we are differentiated. We're not benchmark agnostic portfolio managers. And as we talked, and as Hamersley talked to our investors over the last several months, to get a better handle on how we're being incorporated into asset allocation plans. And so given all that, we have two primary benchmarks. We have the MSCI World. So we do believe we should be able to outperform MSCI World over a full market cycle as defined by 3 to 5 years, knowing that, as Rob just mentioned, we have upwards of 70% of our exposure into industrials and technology. Knowing that, we have high tracking error, so that comes with a fair amount of volatility. So back when we designed GEOS in the infancy, we chose the longest standing clean tech index out there, the Wilder Hill Clean Energy Index. The ticker is ECO, ECO. And that's got the most assets behind it as an ETF, and also the longest track record. So that was founded in 2000. So that gives us an indication of how we're doing relative to the clean tech world, which is going on. Maybe we can have a future webinar on the clean tech cycles, but there's been a lot of volatility. So in the clean tech world, so since 2000, that index is up over 300% from 2000 to 2008, the peak before the Great Recession. So two indices. Why don't we have a ESG index? The answer is that all of the ESG indices that are out there are predicated on all the points that Peter made. They're not solution-oriented, and they're not. They tend to be more inward-looking. on practices, corporate governance, social policy, et cetera, not outward on solutions in the market. There is some effort being made by firms like FTSE and MSCI to adopt new indices around climate solutions. Where we've got actually some that are in place currently that have been developed, and some of them have been redeveloped. But when we look at the constituents of those two solution indices, they're still inward-looking. They're not technology solutions.
Gotcha. And you mentioned another webinar, so you want to do another webinar, I guess, right? we don't
want to wear out our participants.
We would be happy to do another webinar. I think that's it for questions. We're almost at an hour. I know we intended to keep the formal part of the webinar at around 30 minutes. I think we went a little over that, but that's okay. I think we'll stop there and say thank you, Rob, and thank you, Bill.
You.
Good
thank
job.
you all for joining.
And
Appreciate it.
Thank you all, and enjoy the rest of your day. And I think I'll treat these guys to lunch now because they did such a fine job.
Thanks very much.
Have a good afternoon. Thank you.